Bitcoin and Ethereum is you have people in these bear markets that are accumulating at these lower prices that end up like on the way up. They are going to take like profits off the table. And when those profits are in the two biggest pairs in the market, Bitcoin and Ethereum, it is basically gonna affect like the movement of the rest of the market, because these are basically pointing as to where the market's gonna go, which has been definitely like up and to the right. It is a bull market, but we are gonna have really aggressive corrections on the way. I don't know if this is a local top. This could keep going up, but this is very parabolic. This is happening really fast. So Ethereum can keep going. It's just once you go into price discovery, it's indeterminate just how high it can go and when pullbacks are going to happen. So for Ethereum, I would not be surprised if it retested levels like $800. It could even go to lower levels. We don't know like what the price is going to do like during these pullbacks, but that's why you still have like the dollar cost average into coins. Like you can basically then accumulate Ethereum Hex at lower prices, because often what's observed is the human psychology is, oh yeah, I'll buy that dip. It'll be no big deal when it happens. And then when it actually does happen, like 99% of the people are going to turtle away. Yep. And that's why only 1% of people in like markets and investing in general end up being successful. So it's you have to go against like the herd mentality. And if you can't do that, then truthfully, you're just not going to make a lot of money in these markets, because you're going to be the one that's chasing instead of buying when the risk levels are getting lower. You don't want to be buying you don't want to buy coins basically into green candles, even though that's what most of the people do. You want to actually be cost averaging when you start to see red candles, because the risk levels are basically getting slowly reset to a more reasonable level that sets up to the next stage in the market. So if we look at Hex, it had a very similar movement to Ethereum if you look at if you use after big payday, so after big payday, right here on the Hex chart, there was a really big move that happened relative to USD. So
can I just thank you real quick, Wasabi, for using the full chart, unlike a certain Peter individual that I know that zoomed in right at big payday. I appreciate you using the full chart history.
Oh yeah, no problem. Like that's the thing. Like if you're looking at the chart history for Hex, use Uniswap V1. V2 truncates the chart because the liquidity is now on V2. But if you want a macro picture, you have to use like the full price history. You can't just conveniently truncate charts like to what you can't just do that. Like that's not how markets work. Like you want to analyze the full history. Was somebody doing it like maliciously, or was it
I don't know if it was maliciously or if it was out of his own ignorance. It's kind of hard to tell with that certain Peter individual.
Okay, gotcha. Okay.
So we could probably pull up a cool video and show it later if we want to.
Yeah. Because if you use, let's say, like when you're using the full history for Hex, you can get a better gauge as to how aggressive the growth is over basically since the product first launched in December of 2019. So everything that's happening now in terms of the price movements are within the macro trend that it's at now. And this could, like in theory, like this could basically come back down and hit the trend line. It could even dip below and then come back up. These markets, especially at these levels here, you're going to have some huge volatility, and that's just how it is with cryptocurrency. You have basically 30 to 40% pullbacks in bull market cycles. So for example, if Bitcoin pulls back 20%, Ethereum is going to pull back 30 to 40%, and then basically the majors, like Hex is what I consider a major, since it's in the top 10 at this point. You basically just get more volatility with the size of like the economic mass relative to like the Bitcoin or Ethereum. So that's just how and Bitcoin and Ethereum that's how they behaved as well when they were early on in their first or second cycles. That's the volatility is where people get shaken out because whenever somebody sees, let's say, a run up like this, there's always the mentality, oh, I'm going to buy the dip when it happens. Well, now you have the dip. Like this is where you start to think about basically dollar cost averaging your entries in. In fact, Motley and I we were actually going into we actually ended up spending a lot.
Probably a little bit more than what we initially planned on DCA. I know for me personally at least, but then we started talking back and forth. The next thing you know, we definitely put in more than we initially were going to put in that day.
Yeah,
that concept of like just not doing the opposite of what you're supposed to do, or like trying to dollar cost average, but FOMOing in. And I mean, being in crypto for so long, like I've been in crypto for 6 years now, and I've just finally learned within the past maybe 2.5 years to, like I tweeted about this today, that you really need to do the opposite of what your brain is telling you to do. So you're experiencing fear, you're experiencing lack of abundance, right? So you want to get out. And what you need to do is realize that you're in a greater bull trend. So that's exactly when you do buy on red and you sell on green. I finally feel like I finally learned how to do this, and hacks helped me a lot too, because I've actually bought quite a few of these dips. But it's really hard. So I feel for like anybody that doesn't understand that yet. It does take time, but try to listen to that one point that Look Into Crypto mentioned, because that's probably the most important thing that we're going to say like this whole entire time.
And it's like you said, right? It's hard if you haven't been in for like 5 to 6 years at least, because you haven't experienced those cycles that we've been talking about. So you haven't really gone through it, and it's just human instinct like that fear driven, or the FOMO kicks in. It's something you're not familiar with, and you really do have to go against what your initial kind of gut instincts are. And I think even Matty Allen has talked about this before, where you really have to almost force yourself, like, okay, the dip is in, like this is a buying point that I actually need to do. If it doesn't feel good when you're doing it, there's a good chance you're actually making the right play at that time.
If you're in for a longer term, and if you are the bull market. So there's some caveat. It's like,
of course,
go buy
only do it if it feels good. Only do it if it feels good.
Yeah. If you feel bad, do it. If you feel good, don't do it.
Yeah, and this is something like we've even been like after Big Payday, like this we actually were posting charts and stuff like shortly after Big Payday. So we were just analyzing like the movements since then, and basically just whoever bought at these levels, like it just goes to the whole like risk thing. Like we're within a really big consolidation that's going to be really volatile, and